Welcome back to Wick's Market Mortuary. I'm Inspector Wick, Market Coroner. Around here, the market is not a collection of tickers, it is a crime scene. Tonight's patient is not an unknown penny stock dragged in from an offshore alley. This one was once a Wall Street celebrity, a household name, a category disruptor priced as though every hamburger in America had already received an eviction notice. Beyond Meat, ticker BYND. In October 2025, BYND rose from approximately 52 cents to an intraday high of $7.69, a resurrection of roughly 1,379%. 14 trading halts, billions of shares traded, a real Walmart expansion, meme stock attention, extreme short positioning. And then, after the examination lights came back on, the patient returned almost exactly where it started. By July 28, 2026, BYND was trading near 54 cents. The Walmart deal was real, the rally was real, the dilution was also very real. Tonight, we determine what restarted the heart, who supplied the blood, and who received the bill. This examination is for informational and entertainment purposes only. It is not financial advice. Do your own investigation before entering the crime scene. Beyond Meat entered the public market in May 2019 at $25 per share. It opened near $46 and eventually reached approximately $239.71. At the time, investors were not simply buying a company selling plant-based burgers. They were buying a projected transformation of the global food industry. But the transformation developed digestive complications. Competition increased. Restaurant demand weakened. Retail sales slowed. Consumers pushed back against prices, processing concerns, taste, and changing dietary trends. Beyond began cutting costs, reducing staff, restructuring operations, and searching for new life in snacks, beverages, and other plant protein products. By July 2026, the stock had fallen more than 99% from its historic high. The celebrity patient was still alive, but the red carpet had been replaced by a gurney. The Walmart announcement also did not arrive while Beyond Meat was operating from a position of strength. For full year 2025, revenue declined 15.6% to approximately $275.5 million. Product volume fell 15.9%. Gross profit was only $7.65 million. Gross margin was just 2.8%. Operating loss reached approximately $333.6 million. That produced an operating margin near negative 121%. Adjusted EBITDA loss was approximately $179.3 million. Operating cash burn was approximately $144.9 million. Management blamed weak category demand, lower quick service restaurant sales, lost distribution, and heavier promotional discounts. The company was selling food. The economics continued to resemble a charity operating inside a meat freezer. But the immediate crisis was debt. Beyond entered September 2025 with approximately $1.15 billion of convertible notes due in 2027. That maturity was approaching like a hearse with the headlights off. On September 29th, the company launched a debt exchange. Creditors could swap the old notes for new secured notes due in 2030 and hundreds of millions of newly issued common shares. At early settlement, approximately $1.115 billion of old notes had been tendered. Beyond issued approximately $208.7 million of new notes and roughly 316.15 million shares. The final exchange closed on October 30th. In total, approximately 97.44% of the old notes were exchanged. Beyond issued approximately 317.8 million common shares and $209.7 million of new secured notes. Only about $29.5 million of the original 2027 notes remained. The restructuring reduced the immediate debt burden and pushed most maturities farther into the future. That improved the company's survival odds. But the treatment came with a familiar side effect. The original shareholders were diluted into a much smaller portion of the body. The debt did not disappear. It was partially embalmed, partially converted, and handed the keys to the shareholders' waiting room. The share count examination shows the damage clearly. On May 7, 2025, Beyond had approximately 76.5 million shares outstanding. By September 27th, the count was still approximately 76.8 million. By December 31st, it had reached approximately 453.7 million. By March 28, 2026, it was approximately 463.2 million. By May 6th, it had climbed to approximately 515.3 million shares. From May to May, the share count increased approximately 574%. Beyond had roughly 6.7 times as many shares outstanding. The share count bridge also nearly reconciles perfectly. Start with 76.8 million existing shares, add approximately 317.8 million exchange shares. Add approximately 58.9 million ATM shares. That produces approximately 453.5 million shares. The company reported approximately 453.7 million at year-end. Only about 213,000 shares remain unexplained by those three major categories. At year-end, roughly 70% of the company's shares came from the debt exchange. Another 13% came from the ATM. The original share base represented only about 17% of the body. That is not theoretical dilution. That is a fully reconstructed corpse. And the supply cabinet remained stocked. Approximately 165.7 million additional common stock equivalents were excluded from first quarter diluted earnings per share because they were anti-dilutive. Those included shares underlying the new notes, restricted stock units, warrants, options, and other awards. Not every potential share will necessarily be issued. But the morgue does not appear to be running low on toe tags. Now the sequence becomes important. The debt restructuring came first. The Walmart catalyst came later. Immediately before the Walmart announcement, BYND was trading near 52 cents. More than 300 million exchange shares were already being created. The stock had recently lost more than half its value as investors absorbed the restructuring terms and the threat of insolvency. Then, on October 21st, Beyond announced that select products would expand into more than 2,000 Walmart stores. The deal was legitimate. The stock traded as high as approximately $2.91 that day, with more than 1 billion shares changing hands. Then came October 22nd. BYND reached $7.69 intraday. From 52 cents, that was an increase of approximately 1,379%. 14 volatility halts were reported. More than 2 billion shares traded during the frenzy, accompanied by enormous options activity, meme stock attention, and retail momentum. The patient did not merely sit up. It tore off the toe tag, kicked open the freezer door, and sprinted through 14 trading halts. The Walmart expansion created real distribution, shelf presence, and potential sales, but the announcement did not disclose a revenue guarantee. It did not disclose minimum purchases. It did not quantify expected profits, and it did not establish that Walmart demand would reverse Beyond's broader decline. The market reaction was amplified by a recognizable headline: heavy short positioning, rapid options trading, repeated halts, Roundhill adding BYND to a meme stock ETF, and a float that was changing underneath everyone's calculations. On October 23rd, Ortex estimated short interest at approximately 109% of free float. That was not the official Nasdaq figure. It was a real-time estimate using a denominator being distorted by hundreds of millions of newly issued shares. Still, it helps explain the violence. Short sellers were trying to escape through a doorway while the building inspector was still deciding how many doors existed. The Walmart catalyst was real. The valuation response was disconnected from any immediate disclosed improvement of similar size in revenue, margins, or cash flow. And while traders were celebrating the resurrection, the ATM was operating. Between September 27th and October 27th, Beyond sold 58,888,790 shares through its at-the-market program. The company raised approximately $151.7 million gross and $148.7 million net. The average gross sale price was approximately $2.58. By October 27th, only about $2,000 remained under the ATM authorization. The sale period included the Walmart frenzy. But the filing does not disclose daily executions. It does not prove that Beyond sold all 58.9 million shares on October 22nd. It does not prove the shares were sold at $7.69. The accurate conclusion is narrower. Beyond sold nearly 59 million shares during a period encompassing the Walmart squeeze, and the ATM was effectively empty 5 days after the peak. The company did not disclose which candles received the transfusion. It did disclose that the blood bag was empty. 9 months later, BYND was back near 54 cents. That was a decline of approximately 93% from the peak and almost a complete return to the pre-Walmart price. Not every violent rally is fraud. Not every collapse proves manipulation, but a round trip of that size deserves a full autopsy. The financial blood panel did not show a miraculous recovery. For the first quarter of 2026, revenue was approximately $58.2 million, down 15.3%. Gross profit was approximately $2 million. Gross margin was 3.4%. Operating loss was approximately $41.1 million. Operating margin was negative 70.6%. Net loss was approximately $28.5 million. Interest expense was approximately $6.7 million. United States retail revenue fell 15.3%. United States food service declined 29.7%. International retail increased 8.1%. International food service fell 25.9%. The reported net loss was also helped by approximately $11.9 million of derivative remeasurement gains and $6.1 million from debt extinguishment. Those accounting gains made the bottom line appear less severe. They did not improve the burger economics. The same distinction applies to full year 2025. Beyond reported approximately $219 million of GAAP net income. But the company also reported an operating loss of approximately $333.6 million. The positive net income was primarily caused by an approximately $548.7 million non-cash gain related to the debt restructuring. That does not automatically mean the accounting was improper. Debt exchanges can create legitimate accounting gains, but it does not mean selling plant-based meat suddenly became profitable. The patient was declared profitable after debt was moved from one drawer to another, and accounting recorded the sound as a heartbeat. The balance sheet was also more complicated than a simple bankruptcy story. At March 28, 2026, Beyond reported approximately $191 million of unrestricted cash and $14.8 million of restricted cash. Inventory had declined to approximately $68.9 million. The remaining 2027 notes totaled about $29.5 million. The 2030 notes carried a value of approximately $300.5 million. The delayed draw term loan carried approximately $81.7 million. Stockholders' deficit was approximately $21.1 million. First quarter operating cash usage improved to roughly $5 million. That was meaningful, but part of the improvement came from reducing inventory rather than producing a profitable business. Beyond was not an empty shell. It had cash, a known brand, real products, and national distribution. But it also had continuing operating losses, secured debt, interest obligations, and a capital structure capable of producing more shares. The new 2030 notes are secured second lien obligations maturing in October 2030. They carry 7% interest when paid in cash or shares. Beyond may instead use payment in kind interest at 9.5%, adding the interest to principal. The initial conversion price was approximately $1.75. The notes can also create shares through conversions, interest payments, make whole provisions, and other equitization events. Beyond disclosed that it had used the PIK option and expected to continue using it. By May 1, 2026, approximately $10.4 million of PIK interest had already been added to principal. After the first quarter, approximately $62.6 million of notes converted into 52.1 million shares. Employees also received approximately 3.9 million anti-dilution restricted stock units connected to those conversions. The original emergency was reduced, but the replacement life support system can still increase either debt or shares, sometimes both. Management also concluded that disclosure controls remained ineffective as of March 28th. The remaining material weaknesses involved accounting for complex transactions, including compensation, debt, leases, warrants, and assets held for sale. The company also identified weaknesses involving inventory valuation and the accuracy of inventory data. Beyond filed its 2025 annual report late, temporarily restricting its ability to use its S3 shelf and ATM. A material weakness is not proof that every financial statement is false, but unresolved weaknesses increase the risk of future delays, errors, adjustments, and investor confusion. In the mortuary, one mislabeled organ is a mistake. Several mislabeled organs become a procedure review. Now we turn to the recent PepsiCo rumor. The speculation is not completely detached from history. Beyond Meat and PepsiCo created the Planet Partnership in 2021 to develop plant-based snacks and beverages. Its first product was Beyond Meat Jerky. The partnership still appears in Beyond's filings. Beyond had contributed approximately $27.6 million. By the first quarter of 2026, its carrying value had fallen to approximately $1.5 million. The venture generated zero revenue for Beyond in both the first quarter of 2025 and the first quarter of 2026. The jerky product was discontinued in 2024. No reviewed SEC filing, Beyond announcement, or PepsiCo announcement confirms that PepsiCo manufactures Immerse, co-packs it, distributes it, finances it, plans to invest in Beyond, or has entered a new Immerse partnership. The historical relationship is real. The claimed new connection remains speculative. The rumor has a body. It does not yet have a pulse. The verified Immerse distribution partner is Big Geyser. On April 15, 2026, Beyond entered a 10-year exclusive distribution agreement covering a defined Northeast territory. The agreement may renew for additional 8-year periods, but it does not require Beyond to sell a minimum quantity or Big Geyser to purchase one. Big Geyser provides access to more than 26,000 New York area outlets. That creates opportunity. It does not guarantee sell-through. Big Geyser also received warrants covering approximately 4.2 million BYND shares. 2.5 million carried a 60-cent exercise price. Approximately 1.7 million carried an exercise price of 1/10 of 1 cent. Even the beverage distributor left the mortuary with a specimen jar. Finally, there is the Nasdaq clock. Beyond received a minimum bid deficiency notice on March 4, 2026. The initial compliance deadline is August 31st. The stock generally must close at or above $1 for at least 10 consecutive business days. Shareholders have already approved reverse split ratios ranging from 1-for-10 through 1-for-150. The company may qualify for a second compliance period by transferring to the Nasdaq capital market and satisfying the remaining requirements. That extension is not automatic. A delisting could also qualify as a fundamental change under the note agreements, potentially allowing note holders to demand a cash repurchase offer. For Beyond, Nasdaq compliance is not cosmetic surgery. It is connected to liquidity, debt obligations, investor access, and survival. The bull case begins with that survival. The debt exchange eliminated most of the original $1.15 billion note burden. Beyond retained more than $190 million of unrestricted cash. Gross margin improved into positive territory. Walmart distribution is real. Immerse provides a new product category. Big Geyser provides a legitimate distribution network. Short interest remains elevated. A strong earnings report, improved demand, Nasdaq compliance, a successful beverage launch, or a genuinely confirmed PepsiCo development could create another violent resurrection. This patient has already proven it can leave the table without warning. The bear case is equally clear. Revenue and product volume continue to decline. A 3.4% gross margin cannot support the current expense structure. Operating losses remain substantial. The share count increased approximately 574% in 1 year. More potential dilution remains. PIK interest can increase principal. Debt conversions can increase shares. Control weaknesses remain unresolved. Nasdaq compliance has not been restored. The Walmart expansion did not prevent another decline in United States retail revenue, and the PepsiCo rumor remains unconfirmed. Beyond improved its immediate survival odds by exchanging debt for equity and extending maturities. But survival is not the same as recovery. The final diagnosis: catalyst-amplified MIMI resuscitation, complicated by debt exchange dilution and chronic operating failure. Secondary findings: a legitimate Walmart expansion, extreme short squeeze mechanics, approximately 318 million exchange shares, nearly 59 million ATM shares, approximately 574% annual share count expansion, persistent revenue decline, critically low margins, continuing PIK and conversion exposure, unresolved internal control weaknesses, active Nasdaq compliance risk, and a Pepsi rumor still waiting for verified admission papers. Case disposition: critical condition, not dead, not cured. The Walmart headline restarted the heart. The filings show who supplied the blood. The share count shows who paid for it. The patient may run again, but every resurrection should be examined for stitches. This examination is for informational and entertainment purposes only. It is not financial advice. Do your own investigation before entering the crime scene. I'm Inspector Wick, Market Coroner. The chart may move, the filings do not blink.